Good morning, everyone. To new attendees, we say welcome to the Genghis Weekly Investor Briefing. We're very glad that you decided to join us. To the returning attendees, we say welcome once again. We're glad that you are enjoying our sessions enough to attend further sessions. Now, today morning, we are joined by our guest speaker, Mathew Kabeere of FXPesa, EGM Securities. Now, Mathew was with us last week, and he gave us an introduction on the global markets, what kind of commodities are traded on the global markets. He also elaborated on the Genghis Capital and EGM Securities partnership and informed all of us of our access to the global financial markets. So Mathew is back today. Now he's actually going to give us the good stuff. He's going to tell us what's happening on the different markets. And if you have any questions, of course, we look forward to them. Then we have our returning regulars. We have Gerald Muriuki from our research department, who's going to be covering the equities counters. He's going to tell us what's happening on the stock exchange, what stocks are rallying, how the different indices are performing. And if you have any questions related to equities, he's our man. Then we're welcoming Churchill back. We'd missed him terribly, I know. So he's our microeconomics and fixed income professional. He's going to be telling us what's happening in terms of the economic environment and what's happening when it comes to treasury bills and bonds. So Churchill, welcome. We missed you. We're so glad to see you again with us. This is an interactive session. So on your screen, you have the Q&A. So using the Q&A tab, please feel free to drop in any questions you have for either Gerald, Churchill, or Mathew. We also have the chat function that you can use at any point if you have a comment or concern. And at the end of the session, we will address all your queries to the best of our abilities. So I know we're all excited to get something started and to get excited on this very gloomy day. So Gerald, please kick us off.
Thank you, Damaris, and good morning all. Let me share my screen.
Gerald, remember to go into presentation mode. Thank you so much.
Yes. Oh, yeah. Okay, fine. So I'll begin with a recap of what happened in the markets last week. If you look at the indices, they were fairly mixed. NASI was up about 1.1% to 141.21 points, and then NSE 20 was down about 0.7%. To 1799.29. So these are for NSE 20. This is quite a low for the index. I think recently we are trading at almost 2 decades low. Turnover fairly steady at 0.6% up to 1.3 billion. As we noted over the recent weeks, turnover has been quite low. Trading activity has been quite low. I think we usually average at about 3 billion shillings on a normal week, but currently we are seeing 1 billion, 1.5 billion. This, I think, it reflects the environment. We are seeing cases rising again, so it brings all these uncertainties about whether the restrictions will be brought back again, or what is going to happen in the economy. Last week again, top gainers. Standard Group, Flame Tree, Uchumi Express, top losers, Olympia, Fahari Reed, NMG. So one thing you'll notice about the top gainers and top losers, they're usually the stocks that whose nominal value or the nominal price is usually 10 shillings and below. And the biggest, you rarely find the biggest counters in terms of market value. Being in the top gainers or top losers list. So top losers are usually trade mostly on technical indicators and also on very speculative activity. Foreign activity participation 70.3%. I think last week we were at 72%, so quite dominant. The average is usually about 65%. So we are seeing a lot more foreign activity compared to where our local investors are currently trading at. Net inflow last week about 10 million. So this comes from a streak of net selling activity. But when you look at how the flows were coming in, it was fairly from basically from one stock, Safaricom. So they have been quite accumulating Safaricom over the recent weeks, and this tilted the entire market flows to the positive compared to the negative we have been observing prior to last week. So a lot of profit taking on KCB, Equity, Centum, ABL last week. So as noted, it was only Safaricom that had some foreign inflows last week, while the other top traded counters had foreign exits over the last week. So it was traded as the same Safaricom, KCB, Equity, basically the stocks with the largest fundamentals. And we always expect this to remain because they're the biggest and they attract the biggest flows because, again, their fundamentals are also quite solid, and investors usually look more at fundamentals than the technical side of trading. So in terms of where we are trading at compared to SSA, well, our market PE is 9.7, barely moving much these recent weeks. The African average is about 15.3%, but this has been skewed by Mauritius. If you can look at Mauritius, the PE is about 6.48, 64.8% times. So this is distortion as we noted some time back. I think with time this is going to correct because Mauritius usually trade at between 13, 15, and 20 times PE. So there's a bit of a distortion in terms of Mauritius PE. The dividend yield, again, above the African average, we had about 5.2% compared to African average of about 5%. So quite good levels on average, trading levels on average compared to where our other peers in Africa are trading at. So in terms of market, how they traded last week, I think it was quite balanced, a bit of some bearish compared to the previous week. I think it was almost negative for all other markets, for all markets in SSA, but we've seen some bullishness over the course of last week. So looking forward in terms of our trading ideas, what we are recommending this week, given the market is still quite depressed, we're still biased towards the strong stocks with the strong fundamentals, especially the ones that are trading at very good price levels. But in terms of short-term trading opportunities, this week we are looking at BAT Kenya. We expect it to still maintain its dividend, full year dividend, when they announce their full year results. And they look at the dividend yield, about 10%. This is quite one of the best dividend yields that you can get from BAT. Usually, the dividend yield from BAT is about 5%. So we are looking at a forward div yield of about 10%. So we are bullish because when you look at the half-year performance, that's quite positive. I think the bottom line was up about 6%, while everybody else was talking about the pandemic and its effect on the business. So you could look at BAT as a defensive stock, and we expect that given that the second half of the year is much better than the first half of the year, then we expect the performance to still be strong. So again, we are saying that it is likely to be one of the very few stocks that are expected to announce full year dividend this year. As you'll notice, performance for most companies are issuing profit warnings. Performance was depressed as at half year, so most companies are likely to pull out their dividends for the year. So on the other side, profit taking on Britam to Kenya shillings for 8, Kenya shillings 8. I think every time that the price has risen to the Kenya shillings 8 level, profit takers have been coming on board. And this has depressed the prices to below 7 shillings. And when you look at the price multiples, the price to book currently is about 0.76, and then the insurance sector average is about 0.69 times. So So it is a bit of a premium compared to where the sector is generally trading at. And then when you look at their performance was quite negative. I think they post some of the worst performance in terms of half-year results during the period. So despite the insurer posting the worst performance, it's still trading at price to book. So we are recommending that as the price goes to the Kenya shillings 8 levels, investors can look at taking some profit at that level. In terms of corporate calendar, nothing much has changed, except that the books closure for KenGen was adjusted to 9th November. I think it was presently we were at the 22nd of October, but now this has been adjusted to the 9th, and investors should look at that. Thank you. Churchill, you can take over.
Thank you, Gerald, for taking us through the equity segment. Let me take you through the economic segment. To share my screen. I'm glad to be back to the Genghis Weekly Investor Briefing. So I'll start the economic side. In terms of outlook, it's a bit like this week. We're expecting it to more of the discussions to be on the BBI talks, which by now we have all read and internalized before the official launch today. So let me just skip over that bit as I get into the macroeconomic segment. I'll start with the review. Now that I mentioned earlier that this week is a bit light, so I'll start with the review. And this is the budget review outlook paper. This is a document that is tabled by National Treasury. It has to be approved by Cabinet before it's now tabled back to the National Assembly, and it sorts of kickstarts the budget for the next financial year. So what we have from this document, budget review outlook paper, is that revenues have been preempted to go down by 32 billion. Initially it was 1.634 trillion, and now we are seeing it down to 1.61 trillion. So that's a difference of 32 billion decrease. And prior to this final document, we had what was the draft budget review outlook paper, which had preempted that even ordinary revenue will go down further by 110 billion. So what was finally approved is something small than what was expected as per the draft budget review outlook paper. So getting on to expenditure. So we have on one hand that revenues has gone down, but on the spending side, we are seeing, in terms of the national government, we are seeing an increase to the tune of 102.3 billion increase, whereby our current expenditure is expected to go up by 16.8 billion to 1,271 billion, while on the other hand, our development expenditure is expected to go up massively, 85.5 billion to 18.8 billion. We still don't have the details, the nitty-gritties of how much is being allocated to where, be it to Lumanamba, be it to infrastructure, be it to whatever, BBI, or be it to what was being preempted, the credit guarantee scheme, which is expected to be rolled out. It was expected to be rolled out sometime this month. So we still don't have the nitty-gritties. Parliament has gone on recess, that is the National Assembly, and it's expected to be back next week. So we're likely to see the supplementary budget, which is expected to approve these revised estimates, to be tabled next week once Parliament resumes back from its short recess. On the other hand, county allocation, we remember that the first 2 months of this fiscal year, beginning July, August, that there was no disbursements, whereby our able senators were wearing matching ties, trying to hammer out a deal in terms of the equitable share to counties. That was passed sometime early this month, the county allocation revenue bill. But what we are seeing even in the final 2020 budget review outlook paper is that there's an increase to the tune of 26 billion. So here, let me just explain a bit. Last financial year, which ended in June 30th, what had been allocated to counties was around 316.5 billion. But of that amount, I think to the tune of 30 billion was not disbursed to counties. So amidst all those clamoring in the third revenue formula, so what Treasury did in August, they said that they'll allocate the arrears, that 30 billion arrears, to the tune of 26 billion in terms of counties. So that one was done in the month of August. So that's where you can see in terms of county allocation, there's an increase to the tune of 26 billion, and that is stemming from that disbursement, which somehow also increased the domestic financing. So where we have revenues declining on one hand and expenditure going up on the other hand, it's a no-brainer that the financing bit has to just go up. No two ways around it. And that is precisely what has happened, whereby the net financing in the current financial year is expected to go up by 160.7 billion to 1 trillion in the current financial year. So amidst whatever is happening in the country, be it the pandemic, be it whatever BBI, remember that net financing is going up to 1 trillion, and that is representing a fiscal deficit of 8.9% in the current financial year. For net domestic financing, there's a big markup from 494.3 billion that was approved when the budget was passed in Parliament, and now we are seeing it going up to 600 billion. So what essentially that means is that even for T-bills, T-bonds, for the current financial year, we could see that quantum going up. In ordinary times, it could be a signal that the government is desperate for money. But right now, we are not in no ordinary times if you compare with other previous recent times in terms of banks are shying away from lending to the real sector. So we could see it plowing most of the monies back to the government in terms of be it T-bills or T-bonds that are being issued in the next coming months up until June 30th. So that's the state of the macroeconomic as of today morning. So let's just delve into the fixed income segment. Last week, a review of it, we saw T-bonds edged up by 7.2% week on week to 13.3 billion, as in line to expectation. The reopened paper, that is FXP1 2018-25, predominated last week's trade. In terms of T-bills, we saw that was the first negative performance in 3 weekly auctions. The prior 2 weeks, we saw the CBK receiving bids at above 24 billion that they sought, but this time round, it was dived a bit to 19.5 billion. And just looking at the yields, how they have transformed since they're hitting their mid-lows, you're seeing that on average across the 91-day, 182-day, and 364-day T-bills, we're seeing that it has averaged 0.47% since mid-July levels. Looking at the liquidity trend, this is somehow an indicator of how even the T-bonds will be, or even the liquidity T-bills uptick will be. Last week we saw that even the average interbank week on week edging up by 0.26% to 2.62%. And CBK, I normally mention this, it comes out to assess the liquidity situation among the banks at any given day. So last week on 3 occasions, it didn't inject or it didn't mop up any liquidity, but it came on 2 different occasions. That was on Monday and Wednesday to mop up the excess liquidity. It sought a cumulative 20 billion and it received a paltry 7.55 billion out of the money that it sought. Just rundown in terms of the net domestic borrowing, as at the end of last week, we were at 245.3 billion. So that was representative of around 49.7% of the initial target for 93.4 billion. Once the BROP, the final 2020 BROP, has been approved by Parliament, or once the supplementary budget 1 is tabled in Parliament, we are likely to see this target going up from the 494 to 600 billion domestic borrowing. So it will now mean that even in terms of the upcoming issuance, either Treasury will now try to balance even giving us shorter term tenor issues, or as per what we're seeing, the market is not punishing Treasury by the longer term issues that are being put in the primary issuance on a monthly basis. So we're likely to see, depending on the liquidity trends and depending on how the pandemic protracts, this will be a dictator on even how the government will be able to meet these elevated domestic borrowing targets. Finally, this week's trades are still a continuation of what we pitched last week, the trade FXD1 2018-25. This was this month's primary in the primary issue. It has a coupon rate of 13.4%, and what was the weighted average of accepted bids was around 13.49%. And as at the end of last week, the implied yield was around 13.45%. We still expect that yields will continue gradually going back to its pre-auction levels, that was around 13.09%. So investors can take advantage as it comes from the 13.49% that was accepted at the auction back to 13.09%. Investors can take opportunities of entering that trade. Now, I have the singular pleasure to introduce our speaker this week, that is Mathew from FXPesa, and we know that our weekly report is now the cross asset, and it ties even not only the equities and the bonds that we look at primarily as Genghis, but also ensures that investors can have opportunities of looking at the global markets. And I know that right now is the penultimate week to the US elections. So looking forward to see what Mathew has to give us as trade recommendations. Mathew, over to you.
Hey, Churchill, Gerard, Jamaris, a very good morning to all our listeners today. I want to just delve into a little bit of risk management, what it is, and then I'll go have an overview of how the markets were faring last week and what we are expecting. So fast forward, risk management, when you're trading Forex, it's always good that you manage the risks, because of course it's a risky market, and when you get to the market, you don't want to go and lose what you have. So risk management is very important. It's just the ideas or the things that you need to do to make sure that you're protecting your capital, because number one thing when you're trading Forex, you have to make sure that you have money to trade with. Otherwise, if you don't have money, then it's basically you're not in the business. So when you're entering trading, of course, you might think it's fast and easy engagement, but it's an art and a craft that you have to perfect, of course, to make sure you're successful in it. So you want to prevent the likely financial loss within a short time, or when unlikely events happen, because again, it's a market that has surprises.
Mathew, Damaris, let me just jump in. Could you kindly go into presentation mode?
You don't see my screen?
They're seeing only a section of the screen, but I'm seeing right next to the magnifying glass is something that looks like, could that be presentation? Or maybe just expand the screen, because we can see other bits of your computer as well, like your dial pad.
Oh, sorry about that. I don't know what's happening. Let me stop sharing and then share again.
Okay, awesome. Thank you.
Oh, sorry about that. I shared the wrong screen. Now you're seeing it, yeah?
Perfectly, thank you.
All right, so just speaking about the risk management, I think that risk management is just the ideas or the things that you'll be doing when you're trading Forex, just to make sure that you don't lose your capital, because your capital is very important when you're trading. You lose your capital, you're not in the business. And of course, you want to minimize that drawdown on your account to make sure that you can be successful. So fast forward, the most basic things that you need to do is you trade with a stop loss. Of course, a stop loss helps you to close down your trades when you're making losses, right? Because you don't want to lose more than you are anticipating. Of course, you have control of how much you can lose. And then take profit. It's an order that closes in or books your profit once the levels that you are anticipating in the market are achieved, and that's very important. Number two, don't risk more than you can afford to lose, right? If you've invested $1,000 in your account as the capital, of course, you want to take a very small, you want to risk a very small percentage, right? And again, what it means is that you assess yourself, how much do you have, what do you want to invest outside there? When you want to open a business and you're worth, let's say 10 million or 100 million, you don't go and start a business the whole of that amount which you have. So you risk an amount which you can afford to, of course, something that you can afford to lose, all right? Risk tolerance, assess yourself. You want to understand what's your risk appetite, okay? Because of course, when you go to be any business, of course, involves risk. So check yourself, how much risk can you withstand, even as you go out and there to invest. That's when you have to consider maybe your age, your investment goals, how much do you want to earn maybe in a week or in a month, that kind of a thing. How much knowledge do you have? For example, if you're starting up, you need to take a lower risk. Again, risk appetite and the experience that you have. It's notable that younger people are likely to take higher risk, yeah, of course, than the elderly investors. But again, that's a choice to make, but it's important to understand that. So risk to reward ratio, you need to know what you're targeting, right? You don't just go to the market and you speculate and you buy. You need to know what you're targeting. Again, you want to understand what is your reward, what are you looking for? So we have two types of two scenarios that you can look at. For example, you have a strategy where you're winning 70% of your trades, whereby in all those trades, half of them you're getting a lower amount in the trades that you win, but you win 70% of the times. Another scenario is where you have a strategy where when you place a trade, 40% of the time you will win, all right? And when you win, you get a large amount of money. So in this case, what I mean is that it's always good for you to target a higher reward as compared to risk. What I mean is that risk less and target higher, right? That one is informed by your analysis. Again, don't risk more than 2% per trade. This is on the part of how much are you willing to risk outside there, right? Or risk appetite, something like that. Keep consistent on your trading. If you're trading with a lower lot size, don't just go on adding or increasing now that maybe you're getting profit or something like that. Be consistent. Trend is your friend. Always identify a trend in the market before you start trading. Track your overall exposure. When you have a dollar in your pair, for example, or you're trading with a financial instrument that is heavily affected by the dollar, please avoid adding another one that has, or avoid trading with a pair that has got the same base currencies or something like that. So track your overall exposure. You want to manage your risk, not to overexpose yourself. So on the week ahead, last week we had talks on stimulus package in the US still stalling, and it weighs on the market volatility, no deal in sight. And we have the Democrats and the Republicans pushing, of course, trying to see what they might come up with. That was last week. Trump still continues to trail in the polls, of course, as we're waiting for the elections to come up. And again, last week we had earning results driving the performance of the US equities. And this week, the key events, of course, today we're expecting some volatility with the US dollar, of course, with the new home sales. On Tuesday, again, on durable goods. And middle of the week, we have, of course, the Australian market being up and up for the watch because of the consumer price index, and the Canadian side as well on the Canadian dollar. On Thursday, we have quite a lot happening. We'll be having something from the European side, the US, the UK, Japan. Again, these are things that you need to watch on your economic calendar. On Friday, expecting Canadian GDP and the US core PCE. So the products to watch based on that information, of course, gold. Gold is one of the commodities which is affected by the US politics. Remember, gold is denominated in terms of the US dollar. Of course, even we have it in terms of the euro, but most of the times we have the price is being affected when we have events happening in the US. So gold is being weighed on or swayed by the US stimulus discussions in the offing elections, of course, because of the policies that might come up with whoever wins. And historically, there has been movements in the prices of gold, depending with the president or the one who is in charge. And then, of course, on the European side, quantitative easing is likely because we have the COVID-19 flaring up. So currently, we have the gold hovering around 1890s, 1900s. And of course, it's because of those fundamentals there. In the event that it breaches that uptrend, if it breaches that trend line moving downwards to the areas of 1890, you might see it moving all the way down to the support levels of 1870, where if it breaches that one again, might go to the 1850s. And of course, right now we have the demand on the highs of 1930. Again, we just want to see what might happen on the fundamentals. Just maybe it might push up, but something notable is that gold is trading below the moving averages. On the Nasdaq, of course, what's driving that very much? It is the earnings which are being announced, and of course we have the US Q3 GDP announcements, yeah, and some forecast here that they're expecting like a 30% growth. And of course, the earnings on those major tech companies, Apple, Amazon, Microsoft, Google, all those, they really have a big effect on the Nasdaq, which is a tech-based index, and of course the S&P 500. So it's an asset to watch, it's an index to watch. Currently, it's hovering around 11,610, and again trading below the moving averages. If we can see a consolidation there, and if it is able to breach the 11,800 levels, we might find an upside to the highs of 12,200, which if again it breaches, might go to the nearby demand zone of 12,251. On the downside, again, we have the supply on the lower side along 11,200. Again, key levels to watch. What we were waiting so much was on the earnings. Remember, when the earnings are announced, they of course they give the direction. Yeah, if we have higher earnings, of course, gives a good sentiment about that company. If the earnings are bad, then of course it's a bad sentiment for that index. And that's it for me for now. Over to you.
Mathew, thank you so much. Thanks to Churchill and Gerald as well. Excuse me. All right, so that was pretty concise, and I'm glad we've been able to cover all the different sectors. Just had a handful of questions come in, some I've handled, but for Gerald, I think maybe Mathew, we have a question which has mysteriously gone to the answered section, thanks to Gerald. Daniel Adereti had asked, can the equity guy, whose name is Gerald, please touch on the risk premium and its movement over the last 3 months and future movements? So Gerald has responded and said, Risk premium widened initially with the uncertainties, but has now steadied with return to some form of normalcy. So Gerald, do you want to expound just a bit on that?
Yes, so I guess the question was more about the market risk premium, because risk premium generally tends to, it can be interpreted in different ways across industries. But I've answered the question in the context of the market generally. So it widened initially because definitely businesses are expected not to perform as well as they would in a normal environment. But now that the environment has steadied a bit, then we are seeing risk premium return to some form of normalcy.
And Mathew, would you say it also applies to the global financial markets?
Sorry?
I was asking the question, or rather the concern that was had about risk, the initial part of this year, how the pandemic, I assume, had potentially affected the global financial markets. Do you see that kind of risk subsiding now?
So currently, the effect of the COVID-19 is not yet over. Of course, we're seeing it flaring up in the European side. Again, it's a very big effect, and even taking a center stage in the US elections. So I think COVID-19 is very much there and affecting the markets, especially the global markets, but it presents a lot of opportunities, because when those uncertainties come up and investors want to go to the risk-off mode, going to the safe havens like gold, again, it's just an opportunity. It presents opportunities on the Forex side and the global markets. So again, COVID-19 is really playing a big part.
Okay, so if I'm to harmonize Gerald's answer and your answer, because it seems like in the Kenyan market, there is a steady return to normalcy, but in the global financial markets, that it's not the same, like it's playing out differently in Kenya and in the global markets. How about you, Churchill? Is there something that you could comment in terms of macroeconomics and fixed income?
I think what I can just say right now is in terms of the. I think you can mute your mic. Just mute your mic.
Let me just do that.
Yeah, there's some echo. Okay, thank you. So what I wanted to say is that the risk premium that could come in the near term, in my view, is all this elevated political risk. We are hearing about early campaigns period. Right now we have BBI, and those kind of concerns tends to impact majorly on the foreign investors. They account roughly 60 to 70% of the market trading in any given day. So whatever kind of elevated risk concerns to them, majorly from the political risks, tend now to increase the risk premiums that we're likely to see even in the market. So that's just my view on the market right now. And I share and I agree with the sentiments from Mathew in terms of the volatilities across the globe that has predominantly been taken over or being directed by the COVID-19 pandemic. And now there's risk of second wave outbreak, not only in Kenya, but also globally. So those are some of the concerns that tends to elevate the risk premiums, not only in Kenya and also global markets. Back to you, Damaris.
All right, thank you so much for that. All right, let me just go to the next question. We have Mark Bunyi who's asking, Gerald, for banking stocks, are you still recommending KCB and Equity as good buys? So that's the first question. And then Gerald, maybe you could also address Agustin Otieno's question. I believe it's directed to you. What is the essence of top losers and gainers in the market, and what does it communicate to an investor?
Thank you for your question. So for the banking sector, I think we are still bullish for most of the stocks. For Equity Bank and the KCB, since our valuations about a month ago, we haven't seen much movement in terms of pricing, and we still see them trading at very good multiples. In fact, I've just seen the current multiples. We are talking of KCB at 0.9 times book, and Equity Bank at 1.36 times book, which are quite good levels compared to historical averages and also compared to where the market is currently at. So KCB usually trades at about 1.3 times on a historical basis. Equity Bank has traded as high as 2 times, over 2 times historical basis. So these are good levels. Definitely this year we expect performance to be depressed. There's all that matter about the pandemic and where the provisions are expected to move and where the return on equity is going to be. Already we have seen, for example, a return on equity at quite low levels. I think they have been about 15% on average for the two banks, but this is still quite high compared to almost all the other banks that are currently trading in the market. So for the two banks, I still recommend them as good stocks at current levels, but you need to have a long-term outlook so that we can ride out the current pandemic wave. Thank you. So the other question was about the top gainers and top losers. So the essence of the two categories is to show investors who are more risk, who tend to be more risk aggressive, where the opportunities are. Because if you want a much higher return, then you look at the market and look at the stocks that would give you a much higher return compared to, for example, the market average stocks. So for the top losers and top gainers, you find that these tend to be the small stocks. They trend at most of the times below 10 shillings levels, and they don't trade on the strength of their fundamentals. They trade on the strength of technical indicators and sentiment. So for you, if you're looking at risk investment or you have a risky strategy, then those are the categories of stocks that you should be looking at. For the investor who has a longer term outlook and is looking at the fundamentals, then we have the big stocks that usually find them in the top traded list. Thank you. Back to
Gerald, while we still have you here, you could address a couple of more questions. We have
Yes.
Stephen Olo, who is asking about your commentary on the EABL performance, and then Richard Mwangi, who's asking for recommendations of the top 5 buys this week. Richard, I think you must have joined a little late, but I'll allow Gerald to just go over the recommendations for this week. And we also have Adhiambo asking for insights on Unga Group. So that's EABL.
So,
go ahead, sorry.
So I think that is BAT. Today we are looking at BAT. EABL was last week. For BAT, the performance was quite good. It grew its profit after tax about 6%. And that was quite good compared to where most of the stocks in the market were reporting. I think almost all stocks were reporting negative growth in profitability. So given that BAT is a defensive stock, it doesn't get affected very much by macros or what is happening in the business environment, then expect the steady performance to continue into the second half. First half, 6% was solid. That was a very difficult period for most businesses. So second half, business environment has improved. So performance again is expected to pick up quite well. So I expect them to still maintain the dividend at where they offered last year. The second question was about Unga. Unga Group, it's a stock we usually don't follow too much, so I would not be the best person to offer you insight about it. But if you need any details, then we can always communicate on email or even on phone call, and we can look at it in a more detailed manner. The other question, Damaris, I may have missed it.
The other question was Stephen asking about EABL performance.
BAT, that is BAT.
No. Steve Olo was asking about, can you comment on EABL performance?
Okay. Okay. So For EIBL, half year, which is basically full year for them, I think the performance was quite quite as expected. I think when you look at the impact of the restrictions that were there during the second quarter of the year, closure of bars and all manner of restrictions, it impacted the business quite hard. However, given that we are now under a period where the bars have been opened and there's some activity in terms of consumption of alcohol, I think the performance will steady. But I still don't expect them to be quite as good as under normal environment. Again, we are still having the risk, given that the pandemic is rising again. I think we are in the second wave, and there's still that risk about whether the restrictions are going to be reintroduced, and where the business is definitely going towards in terms of revenue performance. However, I think if you are a long-term investor, I think the current price level, last week it traded below 160 level. I think you can look at it favorably, especially if when we ride up the current pandemic, and performance is definitely going to pick up. Before this pandemic, I think performance was at the best performance they have ever announced over the recent past. I think they were on a very good trajectory, investing in BI, investing in Senator Cake, investing in capacity increases in spirits. So that investment is still there, and when the market and the business environment catches up, then performance is definitely going to be where it was, and good performance generally in the long term. But short term, there's going to be some form of a shock. Thank you.
All right.
Damaris.
Thank you so much, Gerald. And attendees, thank you so much for your queries. Just throw us a bone, ask a question to Mathew or Churchill so I can convince them to come back next week. But as I say that, let me just, Gerald, like I always say, you're a very popular guy. But before I go to Kezia's question, I just wanted to address Adhiambo. So Adhiambo, if you'd like to get more detailed discussion on Unga Group, what I would recommend is that you can reply perhaps with your email address, and then we can engage you and continue that discussion. Because as Gerald said, it's not one of the counters they focus on, but would definitely be interested in assisting you in getting information if that's something you want to look at. We have Milka, who's asked Gerald, please explain what PE, price earning ratio, is. So she's interested in learning more about that. Then in the chat box, I saw, just a moment, I saw Lydia asking, Gerald, could you please share an overview of the financial equities in Sub-Saharan Africa? How has COVID-19 affected the first half, and what's your overview of the second half? So maybe, I know you've spoken about it a bit earlier, maybe you could just summarize that. Then I have Kezia, who asked, any comment on the COP Bank performance? So Gerald, back to you. Commentary on price earning ratios, Sub-Saharan performance, and COP Bank. And then I'm happy to see Mark, you're a good guy. Thank you for bringing Churchill to the conversation, but we'll get to that shortly.
Thank you for the good question. So PE means price to earnings ratio. So I'm trying to find out the best way to simplify it. It is the ratio, or it is the price you are paying for each earnings in the business, right? So how much are you paying for the earnings that a company generates over a period? This usually we look at this period as 1 year. So because even in normal business transactions or in normal circumstances, we always pay something in return for something else, right? So we pay a price to acquire a piece of bread. We pay a price to buy a car. So it is a trade-off between how much you are paying and how much you are getting back. So how much you're paying is the price, and what you're getting is the earnings. So price versus value, that is the best way I could put it. How much you're paying for the value you're getting. So the other metrics that we usually look at is price to book ratio. So how much you're paying for the value you are getting in terms of the assets, the net assets of the business, right? So ideally, when you look at those metrics, we want to pay the least amount for the most value you can get. So the lower the PE ratio, the lower the PE ratio, the better for us in terms of investment decisions. So you always want to pay the least for the most amount of value that you can get. The other question was about SSA. I think in terms of financial performance, generally across the board, I think the performance was depressed across the market. And when you look at even the trading metrics on a year-to-date basis, all the markets have come off quite substantially compared to where they were in December and in a similar period over last year. And this is definitely expected to be, to the markets to be generally depressed over the coming months. I think given that most of the markets are not yet they're not yet out of the woods in terms of the effects of the pandemic, then the markets are expected to be a bit depressed over the coming months of the year. Again, when you look at the foreign investors when they are making their investment decisions, they look at SSA as a frontier market, a frontier market basket. So despite the valuations, and the pricing being at a very attractive levels, they would still be cautious in terms of where these countries are expected to be, or how the economies are expected to be, given the pandemic and its effect on the business environment in general in those countries. So Co-op Bank, I think from what we observed in Q2, that is half year results, I think they didn't get. Let me just confirm that. Just a second.
No worries.
Okay.
Gerald, as you look up that information, I can address Titus's question on Q&A. Titus, you're saying you didn't receive the link
sure.
last recording, so I'll definitely include it. I've noted your name. I'll definitely include it in your email for this week, and so you'll get for last week and this week's as well. So that'll be done. So Gerald, you've got the info? You are muted. Okay.
Back to you, Damaris. Yes. So for Co-op Bank, okay. Yes. So in terms of what they reported in AFIA, I think they didn't go as aggressive as its peer Equity Bank and KCB in terms of recognition or provisions for the expected impairment in their assets. I think this is something they'll have to look at, especially in Q3. So we may see some very aggressive provisioning levels in Q3. However, if you note that under the current environment, different banks are applying IFRS 9 provisioning standards in different ways. There's a bit of what I'd call flexibility in terms of how the banks can interpret application of IFRS 9, because some banks are talking about IFRS 9 current environment as a a significant increase in credit risk, but some other banks are looking at it in terms of cash flow constraints. So we'll have different interpretations of how this is applied, but Co-op Bank, I think when they check the numbers, they increased their provisions by about 60%. But when you look at Equity Bank and KCB, they increased provisions by 200%, 500%. So that was quite a significant, uptick in provisions. But for Co-op Bank, they were quite conservative in terms of those provisions. So it will be key to see how they're going to do in terms of Q3. But however, I think their current price multiples are still quite quite good. I would like it at much lower price to book levels compared to where it currently is trading at. Thank you. Back to the Maurice.
All right, Gerald. Let's give you a moment to catch your breath as you prepare to answer the question on the Stanley buy, right? So let me just ask Churchill this question from Mark is asking, in terms of fixed income, are there any T-bonds that are reopening and worth getting into? So Churchill.
Thank you, Damaris, for the question, or rather, thank you, Mark, for posing that question. It's really a great question, and may take some considerable length of time to answer it now that I'm usually put on the task once in a while. So let me just start by saying that in terms of issuance of T-bonds, that usually comes, what happens is they usually committees set up of people from Treasury, CBK, and also some of the market participants who sits on a monthly basis and discusses before they come up with an issuance. For instance, for next month's issuance, it will be communicated once that sort of committee has met and agreed on which kind of issuance will be done. Let me just put it this way, that at some point, Treasury had posed the idea that there could be an issuance calendar, so that at any start of a financial year, say by the 1st of July, you already know that the auctions or the bonds that will be issued over the next 12 months, but that hasn't come into fruition. So that, I think, is still part of the discussions. But right now, what happens is there's usually a committee that sits down and comes up with a recommendation, and that's where the fiscal agent, that is the CBK, now puts out that announcement on their website on any given issues. So let me discuss the three types of issues, more or less. So the first one, it could be a new issue. For instance, CBK may announce that the November primary bond is a new issuance, so it could be, say, for hypothetical example, it's a 30-year issuance, so it could be FXD1 2030. So that's the name of the issue. So it could be a 30-year that has been the first 30-year issuance this year. So FXD1 2020-30. Not that I'm saying that they do that, but I'm just giving it out there as an example. So that is a fresh issuance, and now as analysts or as investors, it's upon us now to get out, okay, what could be the price that CBK is seeking out, and looking at the trends in the market, the liquidity trends, looking at, for instance, if there is an 30-year bond, what is it trading at the secondary market? So that could be one example, coming up with a fresh issue. The other one is now to reopen a paper. So that is just looking at the database of all the bonds that have been issued and say, okay, let's just reopen a paper that we issued 2 years ago. So, and that also happened in the FXD1 2018-25 that was issued this month, and also the FXD1 2011-20. So there were 2 papers that were issued. So those are just reopening of the papers. The beauty of that, about that is already you have those bonds that they are trading. You have a track record of how the pricing will be. So it's easier even to price it as an investor. So I'm not quite sure. I'm not quite sure whether that could be the trend that even Treasury or via CBK will go even in the issuance of the November issue, because what we've seen between July, August, September, now October, mostly has been predominated by reopening of bond issues, bond papers. It could be as a result of just looking at a paper which is illiquid. For instance, by illiquid is that it'll say the outstanding amount is, say, 3 billion, which is quite small. So they may want to reopen it so that it could increase the volume that is traded. So that's in terms as far as reopening of a paper is concerned. And finally, we have what is called a tap sale. For instance, that paper that we are issuing in November, the FXD1 2020-30, and CBK was seeking, say, 50 billion, and it receives 30 billion. So what will happen is CBK will have a tap sale to get that balance, that's 20 billion. So that's where tap sale comes in. there's no pricing. They just say that is once they have been able to attain that 20 billion at what was the accepted rate from the auction, that is where they'll be able to close that tap sale. So those are the three ways that the fiscal agent, now CBK, seeks money. That is through a fresh issuance, reopening of a paper, whose beauty is that you can also look at the secondary market and the tap sale. And just to the short of your question is, we don't know for sure what there will be a reopening in next month's issue. So back to you, Damaris.
Thanks for that, Churchill. We like surprises, so we look forward to see what is reopened. All right, as we draw to the end, Gerald will come back with just two questions I want to consolidate. In the chat function, we had Frank Muhoho who's asking about the Stanley Fahari IRIGHT. I know at some point last year, ICA Lion bought that particular IRIGHT, but perhaps you could give more insight to it. He wants to know whether it's a good buy for the short term or the long term. And John Musembi also touches on the same. He's asking about enlightenment on the IRIGHT. And there's apparently a stock he usually sees, but there's not much activity on it. It's called the Kiruwitu Ventures. What is it kindly? So Gerald, you can answer those two particular questions that I see have you excited. And then I'll just come back and address the last couple of questions that have come in. Okay, Tony, will allow this one to sneak in. What is your take on Umeme? So just those 3 points, and then I'll address the others which are touching on admin matters.
Thank you, Damaris. So for Harry, yes, I think it changed hands from Stanley to ICEA. But when you are looking at Fahari, I think your strategy is towards exposure to the real estate, market or real estate segment. I think it offers, an easier entry point, to diversify your portfolio towards real estate compared to the normal way of investing directly through, the real estate. So in terms of performance, I think the performance was quite steady. That is in half year. And looking at where it is currently trading at, I think the multiples are quite good, given that it's mandated to pay about 90% of its earnings as dividends. I think the current dividend yield of about 13% is quite attractive for you as as a real estate, as a real estate investor in that regard. So you can look at it favorably. I would pick it up at the 52-week low price levels. But then again, you have to consider the dynamics of the real estate market. I think it's going through a bit of some changes, and some of these are going to have long-term impact of those investments and that sector generally. So you should be very keen in terms of where the real estate market is, where the readjustments in that market is going to be, because for example, the mall space, the shopping mall space, I think is a bit overcrowded, and there's going to be some price adjustments in that regard. And then this is definitely going to affect some of those investments that the rate has. So the other question was about Umeme. I think if you are in the electricity sector, yes, this year is difficult again. But if you compare it to where our own homegrown electricity company is performing, I think Umeme is an outperformer, and I think their metrics are much more stable compared to KPLC, where we've seen over the recent 2 or 3 years they've been having some challenges here and there, increase in system losses. I think now we are talking about over 20% increase, over 20% system losses. But also Umeme, we observed some increase in system losses over the recent year that is half year period. So this is not unique to them, but again, for Kenya Power, I think that is much more significant than where Umeme is in terms of the operating metrics. So it is a much more stable and stable business compared to KPLC. I think KPLC right now is has a lot of challenges in terms of cash flow, in terms of business generally, in terms of debt, in terms of tariffs. I think recently I've seen them trying to negotiate an increase in tariffs. So there's a lot that is going on in KPLC compared to Meme, and their business is much more stable and consistent in terms of earnings. Back to Damaris.
All right, thank you so much, Gerald. Mathew, there's a question for you before we wrap up the session. Newton is saying that
Damaris, there was a question about Kurutu. I just remembered it.
Oh, yes, that was John Musembi. He asked about Kuruwitu Ventures.
Yes. Yeah, so I think since its listing almost 5 years ago, it has traded only once. It is an investment company that trades in Sharia compliant investment products, but the details in terms of the assets that they have and what they are doing, I don't have those, so I wouldn't be the best advisor in terms of how you look at that stock, but it's mainly about Sharia compliant investment products. Thank you. Back to Damaris.
All right, thank you for catching that one. Now, Mathew, the question is, considering the US election, don't you think that oil shall also be affected, considering that both parties have different policies towards oil ventures, and the US is among the biggest oil merchants in the world? So that's Newton's concern.
Definitely, you can't leave out oil in this because, of course, again, the US consumes a lot of oil, and the two candidates, of course, have got various policies that might come up whoever wins this time around. For example, with Biden is leaning so much towards the clean energy and the renewables, and of course that one is seen as people are sensing like there's going to be a very big effect on the oil market, and that's on that. And then Trump so much supportive of the oil production. So yes, we have a lot of effect that we might see, of course, with the changing of whether we have the change of the leadership there or whether it will remain, have a very big effect there.
Okay, fantastic. Thank you so much, Mathew. Again, a big thank you for attending our session today. As I prepare to wrap up, I just wanted to address a couple of stuff. Adhiambo, I noted your email address. I remember your query was on Unga Group, so I'm going to link you up with the research team on email as soon as this briefing is over. Stephen Olo, you have a concern on using M-Pesa for depositing into your Genghis Helaimara and CDS accounts, and you're asking for an alternative. Yes, there are bank accounts available. So I will email your, I will send to your email address the different bank accounts available for deposit. I'll share with you that as soon as the session is over. And then I've noted there have been various requests from Lucy, Leah, and others about last week's recording. I know the email came a bit later than usual, but I will definitely ensure that I include last week's link and this week's link on the next email that you receive, so you'll be able to view those again. I think also as a way to making sure you never miss it, when you actually view these videos, you can subscribe to the Genghis YouTube channel. And if you click on notification, anytime that we upload a new video, you actually get a notification. So this way you'll never miss out. I do believe we answered all of you. As always, we are happy to have you in these sessions. This was the 11th episode. I can't believe it's already been 11 sessions so far. The Genghis Capital team continues to enjoy doing this 1-hour sessions, but we're also hoping we're adding value to your investment week. So We'll meet again next week. Keep those questions coming. Keep those engagements coming. You can always reach us on info@genghis-capital.com. So Mathew, hopefully we will see you next week.
Yeah, maybe just a word before we wrap up. I just want to mention that investors and our listeners who want to get more insights on the progress, on how the US elections are going to affect, of course, the markets. We have a webinar on Tuesday 27th at 2 p.m., of course, with the head of futures trading at Equity Group. So once you join our Telegram channel, you can, of course, see all those updates and join that webinar to get more insights. Otherwise, thank you.
All right, guys. So you heard from Mathew. If you're interested in seeing global markets and get involved in this kind of trainings and sessions, be sure to look for FXPesa on Telegram, and you'll be able to get those details. Orem, I've noted. I will also share with you the banking details for Unit Trust. And Titus, let me allow Gerald to reach out to you via email, and you guys can have a discussion on Centum as a value stock. Otherwise, everybody stay safe, and we will see you next week. Thank you so much. Have a good day.